Now friends, let me revise quickly your foreign trade policy. A very simple chapter, but friends, sometimes it is highly focused in the examination condition. So the foreign trade policy is basically a 5-year plan kind of situation, and in this particular 5-year plan, the government will augment the resources so that the India gets more and more foreign trade. That means practically the intention of the government is to earn more and more foreign exchange. The foreign exchange reserves, this is something which is intended to be augmented by this particular foreign trade policy. Put it differently, this is also most of the kind of export incentives. So it is also kind of export incentives. The reason being that India always wants to push. Our Indian economy is basically import-based economy, and government wants to convert the import-based economy to the export-based economy. It's a very difficult task, and that be the reason in India, friends, there is always a lot of export incentives which are provided in form of a foreign trade policy. Now, before I just go ahead, friends, from examination point of view, don't ignore this particular chapter, because sometimes in examination condition, they ask a lot of focus on this particular chapter, and chapter is extremely simple once it is understood. First of all, friends, let me introduce to you two policies. Okay, so as the word by itself, it's a foreign trade policy. So one is MEIS scheme, that is basically merchandise export from India scheme. Okay, and second one is SEIS scheme, that is basically service export schemes. Okay, now these two schemes, friends, MEIS and SEIS schemes, these particular schemes are basically going to give you some incentives for doing export. The one incentive is for exporting goods, the other incentive is for exporting services. Okay, however, friends, this particular scheme is not like open-ended scheme. Open-ended scheme in the sense that anything you export and you will take that particular benefit. It is not like that. So basically, law says that if you are going to export the eligible goods or the eligible services, that means the incentives are given to the specified sectors of the industry. It's not for all the sectors. So if you are giving exports of the eligible goods or the eligible services, then certain incentives are proposed to have been given to you. That means certain percentage. For example, if you are given export value of X amount, then X amount multiplied by Y percentage, which will be again defined by the law. So X value of the export multiplied by the Y percentage is the incentive. So I should not call it as a refund, because it is not the refund of customs duty now. It is, we are outside the customs law now. So it is like an incentive. It is like a cash reward. Okay, so that cash reward will be available to you. Why? Because you are providing that much of exports value to the government. Basically, you are boosting your export-based economy, and that be the reason these incentives have been given. Now here, first of all, let me just focus for the goods. The percentage provided is 5%. Okay, so whatever is the eligible export, multiply with the 5% is the reward, basically the cash incentive which will be provided to you by the government. Okay, now one of the thing which the students has to do from the examination point of view is to remember few things. I mean, you have to mug up few things naturally, because what are the sectors which are eligible for the purpose of scheme and which are not eligible for the purpose of scheme, something that one has to remember. Okay, so this is basically the list of ineligible categories. So these are the items, if you are exporting, then you are not eligible. However, the other things that will be eligible. So the list of eligible, list of ineligible, these things has to be known to the student. So there something like your memory test will come into the picture. So once you know the eligibility criteria, what is eligible, what is not eligible, then you have to just put it into a table that this is eligible, this is eligible. For example, the cereals. Okay, for example, the cereals are not eligible. It is there here somewhere in that ineligible list, something like that. I mean, you have to just remember now that this particular the examination condition, student has to mug a few things. So what is eligible, what is ineligible, you have to identify it properly, put it into the table. Eligible, you just multiply with the specified percentage which is defined by the law, and that is the incentive. This particular incentive is over. Okay, so it is that way very simple computation wise, but one has to remember that what is eligible, what is not eligible. Now in relation to the services, again the same format of computation, but here that particular format of computation is like net foreign exchange gained So that is one of the value that you want for the purpose of this particular scheme. So it is something like you are providing services. So what is your gross foreign exchange earning minus what is your foreign exchange expenses? That means if in order to provide the services abroad, you might have incurred the specified expenditure abroad again into the foreign currency. So basically the net foreign currency that you are gaining, that is something what you want. And of course, with the same thing, you want the eligibility and ineligibility criteria. So that's something students has to remember it only. So for that, there is no choice whatsoever. And so this has the eligible things, what is not eligible, but you have to put it into the format of gross, expense and the net eligible thing. Okay, so your gross earnings, net expenditure and the net earnings, whatever is your net earnings into the foreign currency, multiply with the percentage. That is going to be your incentive for the purpose of providing these particular services in form of an export. Okay, now the next scheme is something like actually this is not a scheme right now, but it is something like benefit which you can give the export cost free. I repeat, you can give the export cost free, and that particular point is something like that. See, waiver of export goods, this is basically free of cost. Okay, free of cost. Now just imagine what is this particular scheme. Now I'm into the international trade. Normally government will not allow, I repeat, normally the government will not allow free of cost export. That means you want to just export the goods just like that. That means you don't want to charge any selling price of that particular goods. That is basically government will not allow. Why it will not allow? That you are sending the goods from India, but you are not getting any foreign exchange back into India, because government always wants export to be done keeping in mind the foreign exchange earning. And if you are doing it free of cost, logically there is not going to be any foreign exchange earnings to the government, and that's the reason government normally will not allow you to do that. Okay, that means exports, anything that you do should have an export value, and this is what something is a fundamental concept. So what people do a lot of that under overvaluations and kind of situation, keeping in mind all these things. But imagine that I am an international trader. I want to send some goods abroad, but I want to send it as a promotional material. I repeat, I want to send it as a promotional material. Now, this promotional material can be in many forms. So, I have my big consignments and my product is already ready, but I want to send, say, for example, free samples, my demo items, maybe I want to send abroad my publicity material, etc. But those things I want to send it as a free of cost. That means I'm not going to charge any export value to that particular front. Now, this kind of situation government permits you, but it is subjected to a limit. Okay, so there is one scheme. The scheme is that you can export goods free of cost. That means your export value will be nil, but still you will be allowed to send the goods outside India only if the basic conditions are satisfied. Okay, so one of the basic condition, friends, is that there should be export incentive. That means you should have, there should be export performance. That means logically you should be an exporter, and when you are an exporter, only then you are going to get this particular benefit. That means just like that, supposing me, I am never export importer and I want to just send the goods outside just like that, normally it will not be permissible in this particular category. Okay, now in this particular situation, first of all, there is one concept of a status holder. Status holder is basically the persons who are giving the export performance, the minimum export performance, minimum annual export performance historically. Okay, so this benefit of export free of cost is permitted only to the status holder. That is one of the points. A status holder is basically called as a star holders. Now, for example, you will get a 1-star rating. You will get a 1-star rating from the law point of view, where your minimum export is 3 million USD. So your minimum performance, the export performance of the earlier years should be at least 3 million US dollars. You get 1 star. Similarly, you get 2 stars, 3 star. If your minimum performance is 2500 million USD, they are all million USDs, okay, and you get a 5-star. So depending upon different stars that you get different incentives under the customs law and this and that kind of thing. But right now what we are discussing, that is your cost-free exports. There you should be at least having 1 star. That means there should be some star rating. If you don't have a star rating, you are not eligible for this particular scheme. Okay. However, if you are MSME, that means medium and small enterprise, then for the purpose of your calculation of the star, there are some extra incentives which are given, like your whatever is the export performance, that is to be multiplied with the factor to get the star. That is only for getting the star. Okay. So for example, there is an MSME. MSME was exporting for 25 lakhs USD, that means 2.5 million USD. There is a factor which is provided by the law for the MSME. So your export which will be counted, I repeat, the export which will be counted for the purpose of star rating is 5 million USD. So 5 million USD comes into the 1-star category, and that's the reason I've already put here 1-star category. Okay. So moment you prove that you are MSME, and so your export performance will be multiplied by double only for the star rating, and once you become a star holder, that means you become a status holder, you are eligible for this particular scheme. Okay. Now in this particular scheme, friends, certain percentage of the export value is your one of the limit. That means how much you can do cost-free exports. So the cost-free exports is subjected to the monetary limit. So certain percentage of the FOB value, there is a specified monetary limit of 1 crore rupees, and whatever is your actual export that you want to do, whichever is less. Okay. So this is something what is provided in the scheme by itself, and that is provided in the scheme here, that the scheme says that limit of 2% of the FOB. Okay. And 1 crore rupees is a monetary limit, whichever is whichever is lower. Sorry, it should be whichever is lower. Okay. However, friends, this particular monetary limit of 1 crore rupees has been withdrawn by the government, but still the institute has not I don't think so they've clearly clarified whether 1 crore is for our examination point of view. So right now, friends, you keep that particular 1 crore limit intact. However, the government has issued some notifications for the withdrawal of this particular 1 crore rupees limit. So however, right now for your examination, you just keep it as 1 crore rupees limit intact. Okay. And here 1 crore rupees is one limit, percentage of the export is another limit, and actual, whichever is less. Okay. So what you can do is a cost-free export in this particular example is 30 lakh rupees to that particular extent. This much is permitted in this calculation. Okay. The next scheme is an advance authorization scheme. The advance authorization scheme is basically you get duty-free imports. I repeat, you get duty-free inputs as an annual authorization. That means you will get an annual limit that once you are an export performer, you get an annual limit to that extent, and to that extent you can bring import which is duty free, and that is a benefit which you call it as an advance authorization. Okay. Some people also call it as a license authorization, but anyway, we'll use the technical name only. We'll say that this is advance authorization. Okay. Now in this particular advance authorization, friends, the scheme is something like that. Whatever is your export performance, I repeat, whatever is your export performance, of that you will have to multiply 300%. Whatever is your export performance, of that you will have to multiply 300%. Now export here for the purpose of this particular scheme also includes your deemed exports. So it is exports or maybe the deemed exports. So you have to multiply 300% or the specified amount, whichever is higher. Okay. So this much is your annual authorization. I repeat, annual authorization. This is your annual, that means per annum limit for duty-free import in this particular situation. And export performance, of course, for all these purposes, last 2 years, that is preceding 2 years performance they will see, and thereafter they will take this particular decision whether you are entitled to or not entitled to this particular scheme. Okay. So supposing if your export and deemed export is 45 and 5, so total is 50, 300% of that is 150, so that is our one limit. Specified amount is already defined by the law. This is already defined by the law. So this is limit 1, limit 2, whichever is higher. So advance authorization based on this much of data is going to be 150 lakhs, basically 1.5 crore rupees. So that much of duty free annually that you can already do that. Okay. The next scheme is EPCG scheme. The EPCG scheme is basically export promotion of capital goods. In other words, export promotion capital goods schemes. In other words, friends, see, if you are exporting something, you want the export quality of the goods. So for that reason, you might have to import the capital goods also. In other words, you should have that some advanced machinery to have that advanced product, advanced finishing, so that your product becomes goods into the international market. So the law says that if you want to bring your goods in this particular scheme, that means capital goods under this particular scheme, you can bring it duty free. That means logically you can save the duty. That means you don't have to pay duty on the capital goods when you are importing this, but there is a condition. The condition is that these capital goods has to be used, of course, but for the purpose of export orientation, and you have to give export performance. Okay, so export performance is something like that. The calculation of the export performance which is required to be given is how much duty you are going to save at the time of the import of that capital goods, multiply with a factor. So that much of performance is to be given. Okay, export performance is to be given, and the factor which is already provided by the law is 6 times. Okay, and this particular export obligation is to be completed in a period of 6 years. So you have to give that much of export value to the government in a period of 6 years. Okay, now the factor is 6. So supposing if you are saving the duty of 5 lakh rupees, that means if you were to import this particular capital goods by paying duty, supposing the duty was 5 lakhs, but that you will not pay to the government. In that particular case, we will multiply with the factor which is defined by the law. So the export obligation pursuant to this particular capital goods import, which is logically the duty free import. So you will have to give the export performance of 30 lakhs in my particular example in a period of 6 years of time, and that's the scheme of the government. However, you can also procure now this is alternative to the scheme. You can also procure the capital goods. I repeat, you can also procure the capital goods indigenously. That means from the domestic market. For that particular case, you will not be importing the capital goods, but that indigenous capital goods, again, it will be duty free or it will be at a concessional duty. But whatever duty that you are saving on the indigenous goods, that is on the domestic capital goods, for that the factor is a discounted factor. So if it is the indigenous goods, then the factor has to be reduced by the specified percentage. The specified percentage is a 25%. So normally your factor is 6. The factor of 6 discounted by 25%. So this is your working here, discounted by 25%. So now your factor is going to become 4.5. So if it was a domestic goods, domestic capital goods, but for the export, in that particular case, your export performance requirement will be on the lower side. And this is basically incentive given for procurement of the capital goods from the domestic market. So this is basically a support with respect to the domestic market in this particular situation, which you call as a export incentive with respect to the capital goods. Okay. Now friends, let me just quickly revise this particular EOU scheme. This particular EOU scheme, export oriented unit scheme, has undergone a little bit of change. See, there are 2 important points that you have to remember with respect to the EOU scheme. In the EOU scheme, that is export oriented unit, okay, ultimately government wants NFEP, okay, that is net foreign exchange positive inflows, okay, and this NFEP, net foreign exchange inflow, or you can say net foreign exchange positive inflow, this is to be brought into India over a block of 5 years, okay, and this 5 years block will commence from the year of commencement of the production. And within a period of block of 5 years, there should be net foreign exchange earning. That means how much your export earnings are and how much your import bills in terms of the foreign currency are. And ultimately, it should be net positive bill. That means India should be gaining foreign exchange reserves out of your particular business. Okay, that is one of the most important thing. The second best important thing with respect to the EOUs. See, as the word by itself suggests, EOUs, etc. They are basically export oriented units. So basically they will import and they will of course practically take a lot of advantage in terms of import, because they are going to after all export it. So basically they are export. That means basically they are going to sell their product in the international market. However, say for example there is a byproduct, scrap, waste, breakage, leakage, all this kind of situation. Basically in the manufacturing process, scrap supposing comes, they can't export a scrap, no. So that particular scrap, friends, they will have to sell it in the domestic market. So can the inputs convert into finished goods? Normally it is to be exported, but can this particular finished goods, or maybe call it as a scrap, waste, byproduct, whatever that you want to say, okay, can it be cleared in the domestic tariff area? Okay, now this particular scheme has undergone a little bit of a change. It says that yes, you are permitted to clear this particular goods in the domestic tariff area. Even finished goods you can clear. waste, scrap, byproduct, whatever, you can clear in the domestic tariff area. That means you can sell it locally because after all you want to raise the funds. However, when you're going to sell it in the domestic tariff area, whatever is the duty payable, you will have to pay that particular. That means all for local domestic clearance, you will have to pay the duty as required by the law. That is one of the very important thing. But the scheme says that okay, now you can clear it off. That means you can sell these things in the domestic market also. Okay, now the previously in the old system there was a monetary limits, but nowadays there is no monetary limit. However, all this clearance is subjected to positive net foreign exchange, okay, over a period of 5-year block. So this is one of the key condition of this particular unit. Now sometimes in the examination condition, now they can ask you a question like, there is one product A, there is a product B. Now product A has been exported, product B has been exported. However, the some quantity of one particular product has been cleared in the domestic area, and some another quantity also they want to clear in the domestic area. So can they clear the some extra quantity of another product in the domestic area? Yes, they can always do that. That means a domestic clearance, domestic tariff area, that means a local sale is permissible. There is nothing wrong, but it is subjected to the condition that there should be a positive NFEP, that is our net foreign exchange should be positive over a period of block of 5 years commencing from the year of the production. So this is permissible. However, for some gem and jewelry type etc. Goods, the government has put the monetary limit that beyond a certain limit you cannot clear the goods in the domestic tariff area. So I'm just assuming that supposing if this both the products etc. was supposing a gem and jewelry product, then what you will do? So you will take the total export. Okay. However, this particular export, as per the technically, it should be export of the preceding year. So that exact data not there in the question, but anyway, just for it's an illustrative thing. Now there is a 10% limit. So of this 2650, you will multiply 10%. So this will be our overall maximum limit for the domestic clearance. How much you have already cleared of one of the product? I'm assuming that both the products are gem and jewelry products only. So, and this is the balance amount which you can clear in the domestic tariff area. But in any case, any clearance to the domestic tariff area will be subjected to the payment of duty. So it is not free of duty that you are going to clear the goods in the domestic tariff area. However, this kind of some monetary limit is applicable only with respect to this particular gem and jewelry. So this particular example was gem and jewelry, and for some service sector some different monetary limit is there. But by and large, friends, there is no monetary limit. I repeat, by and large there is no such monetary limit. Previously there was also a product wide limit. That product wise limits and all that also has been discontinued by the law. Now all this situation, friends, the conclusion is very simple, that EOU can clear the goods in the domestic tariff area subjected to that positive NFE is a key condition. It's the most important condition with respect to the export oriented units.